What is up, YouTubers, and welcome back to my channel. Now, before we dive in, remember, I'm not a financial advisor. This isn't financial advice. This is for educational purposes only. Do your own research, talk to a professional, and invest responsibly. With that said, let's get right to it. We're going to break down 10 ways to identify undervalued stocks with minimal capital. And the best part? You don't need to be a Wall Street hotshot to do it. We're talking about practical tips and tricks that anyone can use, no matter your experience level. So buckle up, grab your coffee, and get ready to take some notes, because we're about to unlock the secrets to finding those hidden stock market gems. Let's do this. First up, we're tackling intrinsic value, the backbone of smart investing. Think of it like this. Imagine you're buying a used car. You wouldn't just look at the shiny paint job, right? You'd pop the hood, check the engine, kick the tires. You'd want to know what it's really worth. That's what intrinsic value is all about. Figuring out a company's true worth based on its earnings, assets, and growth potential. It's about looking beyond the stock price and understanding the underlying business. We're talking about becoming financial detectives, unearthing hidden value that the market might be missing. Remember Warren Buffett's legendary investment in Coca-Cola back in 1988? He saw something others didn't. He recognized the intrinsic value of the company, even when the market undervalued it. And guess what? That investment turned into a massive win for him. That's the power of intrinsic value analysis. It's about finding those diamonds in the rough, those companies trading below their actual worth. Now, calculating intrinsic value can seem intimidating, but trust me, it's not rocket science. There are tons of resources and tools available online, like discounted cash flow analysis, that can help you get started. Remember, you don't need to be a math whiz to do this. Start by researching different calculation methods, find one that clicks with you, and begin practicing. The key takeaway here is to understand that a company's stock price doesn't always reflect its true value. By mastering intrinsic value analysis, you'll be way ahead of the curve, spotting those undervalued opportunities before they even hit the radar of most investors. All right, moving on to our next strategy, focusing on companies with products or services that are in high demand. This one is all about tapping into those powerful market trends, those products and services that everyone wants and needs. Think about it. When a company solves a problem or fulfills a desire that tons of people have, their sales skyrocket and their stock price often follows. Remember back in 2001 when Apple launched the iPod? They tapped into a massive demand for portable music players, and the rest, as they say, is history. Apple revolutionized the music industry, and investors who recognized the potential of the iPod early on made a killing. The lesson here: don't underestimate the power of a product or service that people crave. But how do you identify these in-demand products or services? It's all about research and observation. Look around you, pay attention to what people are talking about, what problems they're facing, and what solutions they are seeking. Check out product reviews, analyze market trends, and see which companies are leading the charge in innovation. Are they constantly coming up with new and improved products? Are they expanding into new markets? These are all signs of a company that's in tune with consumer demand and poised for growth. Investing in such companies is like catching a wave. Ride the wave of demand, and you could see some serious returns. Remember, identifying companies with products or services in high demand is a crucial step in uncovering undervalued stocks. So, keep your finger on the pulse of the market, stay curious, and always be on the lookout for the next big thing. All right, let's talk about a company's performance. This is where you separate the contenders from the pretenders. You're going to want to dive deep into their financial statements. Look at their growth metrics, their earnings reports, everything. What you're looking for is consistency. You want to see consistent revenue growth, manageable debt, and strong cash flow. These are all signs of a healthy company that's heading in the right direction. Think about Amazon back in the early 2000s. A lot of people doubted them. They didn't understand the business model. But those who took the time to analyze their growth, they saw Amazon's potential for what it was: total world domination. And look at them now. Amazon's a behemoth, a household name. And it all goes back to those early performance trends. So, start reviewing those financial statements. Focus on those growth patterns, that profitability. Trust me, it's worth it. Now, let's talk about a powerful tool in your arsenal, the price to earnings ratio, or PE ratio. This little guy can be your secret weapon for identifying undervalued stocks. A low PE ratio can be a huge tell. It often means a stock is undervalued compared to its earnings. It's like finding a Lamborghini for the price of a Toyota. Think back to Netflix in 2010. Their PE ratio was low, and they were just rolling out this new thing called streaming. A lot of people didn't get it, but those who did, they saw the potential, took the plunge, and those early investors, they're laughing all the way to the bank. That's the power of the PE ratio. But you gotta use it right. Do your research. Learn how to calculate it. Compare it across different companies in the same industry, and you'll start seeing those golden opportunities. Now, let's talk about market capitalization, or market cap for short. This is essentially a measure of a company's size and risk level. Smaller market cap companies, those are your hidden gems. They often have the most potential for explosive growth, but they also come with more risk. Think about Tesla back in the day. They were a small company with a big idea, electric cars. Back then, a lot of people thought it was crazy, but those who saw the vision, they invested early, held on tight, and they've been handsomely rewarded. Of course, not every small cap company is going to be the next Tesla. That's where your research comes in. Use market cap as a filter when you're researching stocks, especially small, to mid-cap companies with a strong story and even stronger financials. All right, let's talk about industry and economic trends. This is like predicting the future, but instead of relying on a crystal ball, we use data and research. You want to find those industries that are about to explode in growth, because that's where you'll find undervalued companies. Think about it. If you could go back in time to 2005, would you invest in dial-up internet or high-speed broadband? Exactly. Look for sectors like renewable energy, artificial intelligence, or even space exploration. These are the industries changing the world, and early investors have a chance to see massive returns. Remember the early days of Amazon or Tesla? Those who saw the potential of e-commerce and electric vehicles before they were mainstream made a killing. Don't be afraid to be a contrarian. Sometimes the best opportunities are in the sectors everyone else is overlooking. Do your research, read industry reports, and pay attention to technological advancements. Find those hidden gems in industries with massive tailwinds. Trust me, riding the wave of the future is a much smoother ride to wealth. Now, let's talk about you, the small capital investor. You might be thinking, Graham, this is all great, but I don't have millions to throw around. And you know what? That's totally fine. There's a strategy for you, dollar cost averaging. This is how I started. And honestly, it's one of the most powerful tools for building wealth over time. The idea is simple. Invest a fixed amount of money at regular intervals, no matter what the market is doing. Think of it like putting money into a high-yield savings account every month. You're not trying to time the market or find the absolute bottom. You're simply investing consistently, which takes the emotion out of it and reduces your risk. Remember, building wealth is a marathon, not a sprint. By dollar cost averaging, you're buying more shares when prices are low and fewer shares when prices are high. This smooths out your average cost and maximizes your long-term returns. All right, let's talk about risk management. You see, even if you find the most undervalued stock in the world, you never want to put all your money into it. Why? Because anything can happen. That's where diversification comes in. Diversifying your portfolio is like having a backup plan, or even better, multiple backup plans. You want to spread your investments across different stocks, sectors, and asset classes. Think of it like this. Would you rather have all your money in one stock that could potentially plummet? Or would you rather have it spread across 10, 20, even 50 different stocks in different industries? I know what I choose. Remember the saying, don't put all your eggs in one basket? Well, that applies to investing too. By diversifying, even if one investment takes a hit, the others can cushion the blow and keep your portfolio growing steadily. All right, so you're ready to start digging for those undervalued stocks, but sifting through thousands of companies sounds like a headache, right? Well, that's where stock screeners come in. These tools are like having a personal assistant for your investments. They do the heavy lifting, scanning the market based on your specific criteria. Think of it like this. You wouldn't walk into a grocery store and just start grabbing random items, hoping to find a good deal on your favorite cereal. You probably head straight to the aisle you need, right? Stock screeners are similar. You tell them what you're looking for. Maybe it's a low PE ratio, consistent revenue growth, or a specific industry, and they'll generate a list of companies that fit the bill. Now, some popular stock screeners I recommend checking out are Morningstar, Seeking Alpha, and Yahoo Finance. These platforms offer a range of features, from basic filtering to in-depth analysis. Don't be afraid to experiment with different screeners and criteria to find what works best for you. Remember, the key here is to use these tools strategically. Don't just blindly trust the results. Always do your own research on the companies that pop up on your radar. But trust me, using stock screeners is a total game changer when it comes to efficiently identifying potential investment opportunities. Now, maybe you're thinking, Graham, this all sounds great, but I'm not quite ready to dive headfirst into picking individual stocks just yet. And hey, I totally get it. It can feel intimidating, especially when you're just starting out. The good news is, you can still get in the game and potentially benefit from undervalued sectors without having to analyze every single company. That's where ETFs and index funds come in. Think of them as pre-built portfolios that track a specific market index like the S&P 500. With a single investment, you can gain exposure to a basket of stocks, providing instant diversification. It's like having a team of financial advisors working for you, but at a fraction of the cost. For example, let's say you're bullish on the renewable energy sector, but you're not sure which specific companies to invest in. You could invest in a renewable energy ETF, which would spread your money across a diversified portfolio of companies in that industry. This way, you're participating in the sector's growth potential without the risk of putting all your eggs in one basket. Remember, ETFs and index funds are all about keeping it simple and efficient. They're a fantastic option for beginners who want to start investing without getting bogged down in individual stock analysis. Plus, they're extremely cost-effective with low expense ratios that won't eat into your returns. So, there you have it, 10 powerful strategies to help you identify undervalued stocks and potentially supercharge your investment portfolio, even with minimal capital. Remember, building wealth is a marathon, not a sprint. It's about making smart, informed decisions that align with your financial goals. Investing with minimal capital doesn't mean you can't achieve big results. These 10 strategies are your blueprint for identifying undervalued stocks and building long-term wealth. Remember, every successful investor starts with a single step. Your journey begins today, and the choices you make now will shape your financial future. Which strategy are you most excited to try? Let me know in the comments below. If you found this video helpful, hit that like button, subscribe to my channel for more financial tips and tricks, and don't forget to share this video with someone ready to start their investing journey. Thanks for watching, and I'll see you on the next one. I see it, and this and truck or trade.